Welcome to the Torrent Insurance Solutions webinar on 2015 changes and recent historical changes to the NFIP Write Your Own Flood program. My name is Bill Coughlin, Director of Client Growth, Torrent Insurance Solutions, and assisting me today will be Laura Petty, ANFI, Training Manager with Torrent Insurance Solutions. Today, we are going to cover the changes that have occurred with the NFIP Write Your Own Flood program. I think it is important to walk through the historical process to get a complete understanding and the effect these changes have had and will have as we work in 2015. As you may already know, there have been some pretty major changes to the NFIP over the past few years. We don't have time to go through every one, so we'll limit it to some of the more important and recent changes. In today's short program, we'll limit the focus to recent changes that have occurred in two areas. In the National Flood Insurance Program, which is the insurance we offer, and specifically the changes that are taking effect on April 1st. So let's get started. Starting with the recent passage of the Homeowners Flood Insurance Affordability Act and how it affected the previously enacted Biggert Waters Reform Act of 2012. The term BW12 is reference to the Biggert Waters Reform Act. The Grim Waters Act, or GW14, is also referred to as the HIFA, or Homeowners Insurance Flood Affordability Act. Now, back in the summer of 2012, Congress passed legislation affecting the NFIP titled the BW12. BW12 has both good and challenging effects on the NFIP. On the good side, it officially renewed the program through September of 2017, putting an end to the series of last-minute extensions and a few short program shutdowns occurring between 2009 and 2012. BW12 had some other positive impacts as well, but it was most noted for its provisions phasing out the use of pre-firm rating, the rating method offered to older buildings constructed in the floodplain before the community adopted its first map of the floodplain, and the strict building codes relating to it. BW12 went about eliminating pre-firm rating in several ways. First, it required 25% annual premium increases on non-primary residences and commercial buildings. Secondly, and most controversial, it immediately eliminated the use of pre-firm rating if certain events occurred. As some of you may have been involved with, under the right circumstances, the switch from pre-firm rating to rating based on the building's specific elevations relative to the elevation of the floodplain resulted in huge premium increases. The most unfortunate policyholders saw their premiums climb to over $10,000 a year. Well, as you can imagine, that didn't sit well with the affected insureds or with the real estate industry, as in many cases, the huge BW12 related premium increases motivated potential home buyers to back out of sales rather than purchasing the home and being faced with such a huge, large annual premium. So, all these unhappy property owners and real estate professionals did a lot of complaining, especially to their representatives in Congress. And after hearing enough of these complaints, Congress acted by passing new legislation titled the Homeowners Flood Insurance Affordability Act. That's the Homeowners Flood Insurance Affordability Act. Now, if we picture the BW12 as a big cookie, the Homeowners Insurance Affordability Act came along and took a great big bite out of BW12's controversial provisions. It didn't eliminate them all, but it did take out those producing the most frequent complaints, and it did so retroactively. In some cases, the Affordability Act said, hey, we screwed up. Let's go back and act like BW12 never even happened. The Affordability Act reinstated the use of pre-firm rating, even if any of the events targeted by BW12 occurred. So for lapsed policy reinstatements, property sales, and the issuing of brand new policies, pre-firm rating can be used to calculate the policy premium. It also placed an 18% cap on the premium increase of any policy insuring a primary residence. As a result of the retroactive nature of the Affordability Act, policyholders who paid higher premiums because of BW12 should have received their refund checks. Those started going out on October 1st, and we have completed 99.97% of all refund checks to your policyholders. As I stated previously, the Affordability Act didn't undo everything BW12 put in. Those 25% annual increases for non-primary residences and commercial buildings I mentioned on the last slide were allowed to continue. Although the increase on commercial buildings will be rolled back temporarily, while the NFIP folks firm up exactly which buildings fall into that category. Also, Congress had to find a way to pay for the Affordability Act. And what I mean by that is they had to calculate the money the program was going to lose as a result of the rolling back or undoing of BW12's premium increases, and then figure out how to generate the money some other way. They came up with two ways to do that. First, they implemented deductible increases on certain policies, which we'll look more closely at in a bit, along with the deductible increases. They developed surcharges to be applied to all policies. Essentially, rather than charging a few unfortunate policyholders huge premiums, they decided to charge every policyholder a higher premium. The surcharges will begin April 2015 and will be $25 on primary residences and $250 on all other policies. That includes preferred risk policies. We'll discuss this more in detail later in the presentation. The NFIP also changed their definition of a primary residence this past year. When a primary residence used to be defined as one and insured actually occupied at least 80% of the prior year, or of the time they owned the home if they haven't yet owned it for a year, it is now defined as one and insured will occupy more than 50% of the policy term. The key thing here is more than 50% of the policy term. The good news with the definition change, along with it following a more logical understanding of the word primary, is that more homes will qualify as primary. Under the provision's 80% requirement, anyone with a secondary residence, such as snowbirds who spent time between a northern and southern state, or anyone with a lake home, they spent much time and would end up not having either home qualify as primary. Now, as I mentioned earlier during the Biggert Waters versus Affordability Act discussion, pre-firm primary homes will be charged a lower premium than non-primary homes will, especially once the surcharges start applying. And that difference will become more significant with each passing year going forward. Now, the bad news with regarding primary homes is the NFIP is now requiring documentation to prove a home's primary residence. Acceptable documentation of a primary residence can come in the form of any of the documents listed on the slide. In each case, the address shown on the documentation must be the same as the property address indicated on the flood policy. Now, an exception has been made for those clients needing proof of flood coverage for the closing on a new home purchase. FEMA has recognized that those just buying a home will not have transferred the required documents to the new address yet. And so, for those clients, all we'll need is a signed statement indicated the new home being purchased will be occupied as their primary residence. Now, a specific form created by FEMA must be used in this situation. Now, this form can also be used if you have a situation where the insured legitimately doesn't have any other required documents. For example, a very elderly person who doesn't drive or vote anymore. The NFIP has now indicated that we can use the verification of primary residence status for NFIP rating on all pre-firm subsidized rated policies. A pop-up will appear to help you locate the document on your computer or office network. Click on Find Documents to locate it on your system. Then click on the desired document to highlight it and hit the Upload button. Your document will be attached to the policy file and the policy will be flagged for review by an underwriter. And that's it. On June 1st of 2014, the NFIP began offering a higher building coverage limit on buildings falling within their other residential classification, which includes those with 5 or more residential units and a normal occupancy period of at least 6 months. Now, probably the most common other residential buildings are apartment buildings or co-ops, but it also includes dorms, assisted living facilities, and any other 5 or more unit building where people typically reside there for 6 months or more at a time. Note that the most hotels and motels which offer rooms or suites for shorter periods of time are considered non-residential by the NFIP. Previously, the highest building coverage limit you could offer on an other residential building was $250,000. Obviously not much coverage relative to the value of most apartment buildings. Effective June 1st, 2014, the NFIP began offering building coverage limits of up to $500,000 on these buildings. Arguably still not much coverage for these kind of buildings, but certainly an improvement. Note that only the building coverage maximum limit increased. The maximum contents limit did not change, and that remains at $100,000. Okay, beginning with new business and renewal business, additional changes will be implemented according to the Homeowners Flood Insurance Affordability Act of 2014. The changes will slow some of the flood insurance rate increases and offers release to some policyholders who experienced steep flood insurance premium increases in 2013. In addition to insurance rates, other changes resulting from Biggert Waters and Haifa will be implemented that will affect the total amount a policyholder pays for a flood insurance policy. So let's take a look at the highlights of some of these changes. The Affordability Act included a number of increases to the minimum policy deductibles, primarily for pre-firm rated policies. As you look at the chart, the minimum deductible for certain policies will be increased as shown on the slide. As you can see, the increases are modest on policies rated with full risk, tentative, or provisional rates, but are more significant for policies insuring pre-firm rated buildings or that are issued for buildings located in emergency program communities. Now, a couple of things to note. Policies with no building coverage are not affected by the increase, regardless of the contents coverage limit or the rates used on the policy. So all contents-only policies can be issued or renewed with a deductible as low as $1,000. The minimum deductible shown on the slide apply to both the building coverage and contents coverage when both coverages are provided by a policy affected by the increase. We also have a new $10,000 deductible option available for residential property. Haifa has created a new maximum deductible of $10,000. This will be eligible for all residential buildings. If this is selected, it will apply to both building and contents. So just remember, that would be a $10,000 deductible on the building and a $10,000 deductible on the contents. So this may not always be the most financially acceptable choice to make. The $10,000 deductible will create about a 40% discount on a residential dwelling. It is your insured's responsibility, however, to get the approval from their lender to use this larger deductible. How many of you have seen updated flood maps released in your area? Usually the new flood maps are released on a county-by-county basis. If you haven't experienced a new flood map release yet, you will. Before they're completed, FEMA will have updated every flood map across the entire country. Obviously, there's a major effort and it will take some time to complete. Implementing a new procedure for properties newly mapped into a special flood hazard area and existing preferred risk policy eligibility extension, a cost-saving flood insurance coverage option for property owners whose buildings were newly mapped into a special flood hazard area. The premiums will be the same as the PRP, which offers low-cost flood insurance to owners and tenants of eligible residential and non-residential buildings located in the moderate to low risk areas for the first year. Now, when flood maps are updated, a number of results can occur. Some properties can be removed from the floodplain. When that happens, policyholders can be released from the flood insurance requirement imposed by their mortgage lender, giving them the option to cancel their policy. When you run into this situation, please make sure the insureds understand they do have alternatives to the cancellation. Since their property has been reclassified from an A or V zone to a lower X zone, they now qualify for a much lower premium through the Preferred Risk Program. They can even choose to reduce their premium further by reducing their coverage, since there's no longer a lender telling them how much coverage they must purchase. If they still choose to cancel, at least you've done your job by letting them know their options. Now, other property owners will find that they've been added into the floodplain, usually when they receive a letter from their lender telling them they have 45 days to secure coverage themselves before the bank force places it for them. In those cases, we can help you confirm whether they qualify for the premium breaks offered by the NFIP's newly mapped rating or through grandfathering. Let's recap the highlights on the map changes. Newly mapped and the high risk will receive the newly mapped rate for 1 year and then continue to increase until these rates meet or exceed the standard rates. The federal policy fee is increasing to $45 on each of these policies. Rates will not increase more than 18% limitation under the HIFA guidelines. Grandfathering is still a good cost-saving measure. When flood insurance rates map changes occur, the NFIP provides a lower cost saving rating option known as grandfathering, which is available for property owners who have done the following: have flood insurance policies in effect when the new flood maps become effective and then maintain continuous coverage, or have built in compliance with the flood insurance rate map, in effect at the time of construction. You can learn more about the details of grandfathering at the FloodSmart website, as we've listed here on the slide at floodsmart.gov. The purpose of all the changes since BW12 is bring the NFIP to a more actuarially sound rating process. This, of course, means that we will have rate increases, but limited to a lesser amount than the original BW12 rates. Under the HIFA, the following rate changes and limitations will be in effect. The average annual increase in flood premium has been limited to 15% for each class of risk. The average pre-firm subsidized policy will increase at least 5%. Now, 18% is the maximum increase for any individual premium increase. Now, there are a couple exceptions. Misrated policies or any with an increase to coverage limits. Subsidized policies subject to the 25% increase, which are the non-primary residence, severe repetitive loss property, and substantially damaged or substantially improved properties. The current policy fee is being adjusted upward with the exception of the preferred risk policy, and it will remain at $22. All other policies will have a $45 federal policy fee. Now, the newly mapped property to a special flood hazard area will have a $45 fee on policies with an effective date of 4/1/2015, and the map revision date is 3/21/15 or later. Biggert Waters required the establishment of a reserve fund to help cover costs when claims exceed the annual premiums collected by the NFIP. FEMA began collecting an assessment in 2013 to add money to the reserve fund. The reserve fund assessment initially applied to all policies other than PRPs in 2013. The assessment on those policies will now increase in 2015. Starting in 2015, PRPs will begin contributing to the reserve fund. Now, as you can see, the preferred risk policies are going to go from 0 to a 10% fee. The newly mapped properties will go from 0 to 15%, and all other policies who were previously paying 5% will now go to a 15% charge. HIFA slowed the elimination of subsidies provided for in the Biggert-Waters bill and amended most of the provisions maintaining that certain policies transition immediately to full risk rates. To compensate for the decrease in revenue, the new law calls for the addition of a surcharge on all policies that will be collected until, with limited exceptions, all subsidies are eliminated. The surcharge is a flat fee applied to all policies based on the occupancy type of the insured building and is not associated with the flood zone in which the building is located or the construction date of the building. Does not matter whether it's pre-firm or post-firm. Now, a special note here, the surcharge also applies to a renter's contents-only policy based on the policyholder's occupancy of the building or unit. Beginning April of 2015, the transfer of business from one agent to another or one company to another company has some new provisions and terminology. Photos will be required on all policy transfers on or after 4/1 of 2015. However, you will be able to use the photos from the previous carrier file if available. The one exception to this is that no structural changes have been made to the building. You will also need to verify the documentation for the primary residence. The term rollover is now being changed to transferred from this date as well. Here is some examples of how the average premium increase by zone. The first column is the premium increase including the Federal Reserve Fund assessment. The second column shows the total premium average increase including the federal policy fee, the new HIFA surcharge, and any applicable probation surcharge to the policy. Now, just be aware these are all averages, and each property and zone will take on its own rating scenario. Remember, all this is being mandated by Congress and not your WYO company. So let's just take another minute to view that screen here. With all new premium increases and additional fees, it is important to inform your client that the NFIP policy can only be canceled for specific reasons. This also applies to the new surcharge as well. Example would be the insured purchases an NFIP policy and is upset and cancels to buy a private market policy or just not carry flood insurance. No refunds will be allowed. Now you can see a list of the specific refunds on the surcharge where the refund could be issued. As the little sign says in the corner, all other cancellation provisions of the NFIP still exist. You can get a refund if we find out the risk is not eligible, the property closing didn't occur, the policy was written to the wrong underwriting facility, cancel and rewrite because of a map revision, voidance prior to the effective date, voidance due a credit card error, and cancellation of a duplicate policy. Confusion will exist when we say in one place that a policy is limited to a 15% increase due to class of risk. 18% is the maximum policy premium increase on an individual policy. We have to be prepared to explain to the insured that the percentage of increase only relates to the premium and not the total of premium, fees, surcharges, and reserve fund fees. The fees are not included in the calculation of any agent commission. Now, something new and quite relative is part of the BW12 Reform Act included a provision that would require implementation for agents and policyholders notification in cases where duplicate coverage is indicated. This does not apply for individual units within residential condominium buildings. Reports are currently being developed to identify those properties, and notifications will be forthcoming. Please watch for agency bulletins on your dashboard notification for more information and action needed. Now it's time for questions or comments. Please raise your hand on the toolbar for the webinar or submit your question or comment on the chat or question box on the toolbar. We will try to respond to all your questions that you sent on the chat or questions. If you wish to ask a question, please raise your hand now. Thank you for your time today, and we hope that you have learned some information regarding the changes in the NFIP program. We are here to help you, so please ask. You are able to contact us through the chat feature, which you will always see in the blue toolbar at the top right-hand side of the screen. You also can find our phone number in the Help menu and then select Contact Us. Please send your comments or suggestions to training@torrentcorp.com. That is training@torrentcorp.com. Thank you again for your time in joining our webinar today.